One of the biggest hurdles and even excuses for doctors and people of other professions for that matter is that investing is too risky or investing is complicated or I'm so busy with clinic or residency that I don't have time to track all these stocks, I'm just not going to invest. Well, I'm here to tell you that there are ways to invest easily and with minimal risk, and that's what this video is about. Let's get to it. Hey guys, it's Dr. Andreas here. Usually this channel gears towards optometry, but since we're tackling investing again, this video is appropriate for any doctor, healthcare professional, and actually any person of any profession. If you like this video, please hit the like button below and consider subscribing, but off we go. Quick disclaimer, I'm not a financial advisor. This video is for educational purposes only. Even though investing can be safe, it still does involve risk, so please still be responsible and do your own research. Individual stocks versus mutual stocks. So when people think of investing, they mainly think of, oh, I just bought an Apple stock, or I just bought 4 stocks of Netflix, or 2 stocks of Southwest. And those are all individual stocks, which yes, they can make you a lot of money. They can also make you lose a lot of money too if you're unlucky, or if you haven't done your research on the company. And so this volatility is what usually drives people away from investing, especially if they don't have the time or expertise in risking their money. This is why the best way to start investing, especially as a beginner, is to focus on what are called mutual stocks. Other similar terms for those are index funds, index stocks, mutual funds, ETFs. A mutual stock is a stock that you buy, but it has smaller pieces of other stocks in them. So to simplify it, one mutual stock could mean 0.1 stocks of Apple, or 0.1 stocks of Netflix, Amazon, and so on. Mutual stocks are deemed more reliable than individual stocks because if Netflix goes down, for example, it's not a big deal because you still have some of Amazon or Apple that may go up to compensate. Basically, owning a mutual stock is a way of diversification, which means you don't have all your apples in one basket. It also makes investing safer and simpler. Index stocks. Now, some of the best mutual stocks can be those that follow an index, and that's why you hear the terms index funds or index stocks. An index would be, let's say, NASDAQ, which is an index full of technology stocks. So if you own a mutual stock that follows a NASDAQ index, then you own a bit of Apple, Adobe, Amazon, Google, Activision, all the tech stocks. You want your mutual stocks to follow an index because it's efficient and it's cheap, as opposed to buying an actively managed mutual stock, which means some expert is picking which stocks are going to be in the mutual stock. These choices are dependent on the expert's analysis of which stocks should perform the best. The problem with that, though, is that timing of the market is impossible. We can't know the future on which stocks will perform better than others or which stocks will rise or fall in price. We can only make an educated guess. So not only do those actively managed mutual stocks not always deliver, but they cost more money in fees, so just stick with index funds for now. This advice is actually coming from investing legend and billionaire Warren Buffett, who made a bet that his index funds would outperform these expert-run mutual funds, and he won. In fact, in a famous letter that Warren Buffett sent to his shareholders in 2014, he said that if he were to die, my advice to the trustee for my wife could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index mutual fund. That's it. Which leads us to talking about arguably the best index out there, the S&P 500. So some of you may be thinking, okay, just cut the chase, I want to invest now, what should I buy? And if I had just one index to pick, it would definitely be the S&P 500. This index is basically a list of the top 500 largest companies in the United States. Netflix, Google, Amazon, Microsoft, Facebook, Johnson & Johnson, etc., all the heavy hitters. You can't go wrong with this index because the S&P 500 has netted an average of 10% growth every year since the 1920s. That's insane. Let me show you this diagram here. So this shows 6 different charts. In each chart, there's a horizontal line. If the bar goes above the line, it means the index made more money. If the bar goes below the line, it means the stocks lost money. So in the first chart, you see the monthly returns of the S&P 500 over the past 80 plus years. And that looks pretty volatile. Only 62% of months did the S&P 500 make money. So the S&P 500 might net 20% on year 1, but then on year 2, it might go down 5%. And this volatility is what scares people from investing. The stocks keep going up and down, they say. But the next chart shows the same stock's returns, but in increments of 1 year. Now you're seeing that the S&P 500 is making money 71% of years since 1926. And then when you look at returns of the index per decade or per 20 years, you see that the S&P 500 has always been positive in those 10 to 20 year increments since 1926. That's why if you put money into the S&P 500, it's a pretty safe bet that it's going to be worth a lot of money come 2050. So $100 worth of S&P 500 stock in 1926 is now worth over 64 grand, even when you consider inflation. And the best part, guys, you're free to add money every month or every year or whenever you feel like it without really looking at what the current price is. You don't care if the stock has gone up or down because you know that even if the stock zigs and zags, it always ends up zigzagging upwards, so your stock is bound to go up. That's why you don't have to be at work thinking, oh, I wonder how my stocks are doing. Of course, there's still a risk involved with buying any stocks, but with the S&P 500, you're not betting on one stock, you're betting on the US economy, baby, which has been very reliable in the long term. Another thing not to worry about too much when investing in index stocks is world events. Basically, no matter what is going on in the world, keep investing regularly in the S&P 500. I know right now people are worried on what is happening this year, but the truth is that world events will not destroy your stocks. In fact, if you look at this table here, which is a little outdated, I admit, you can see that despite there being a major crisis almost every year since 1940, the S&P 500 and hence the US economy has done remarkably well. So this is why I say this is how you can safely invest. There's still risk that your money may fluctuate or it may go down, but if you don't panic sell and just stay the course, chances are your money will rise again if you give it enough time and probably be higher than originally. A good example is even after the stock market crashed on March of 2020, as of November 16, 2020, the S&P 500 is already above what it was before the crash. That's pretty cool. Alright, so if you want to buy the S&P 500, just log into your online brokerage website, whether through the company Vanguard or Fidelity or Charles Schwab or wherever, and then look for the ticker symbol VOO, which is Vanguard's index stock that mimics the index of the S&P 500. That's the one I have. Now I know that you can buy Vanguard stocks even if your online brokerage website is not Vanguard, but there may be a fee, so just look into that. Other examples of index stocks that follow the S&P 500 are ticker symbol SPDR or IVV. They're all basically the same, but may have different expense ratios. Every index stock is going to have an expense ratio, by the way. Basically, just Google each index stock that you're interested in and look at the expense ratio. The lower the expense ratio, the better, but honestly, anything that is lower than 0.1% is pretty good. VOO is actually 0.03%, which is awesome. That means that if you have 10 grand worth of VOO index stock, that's just a $3 fee a year that the brokerage will take to keep this index stock running, which is pretty reasonable considering that 10 grand is probably gonna grow by 1 grand that same year. 401k versus IRA. Okay, the last thing I want to cover in this video is the way you invest. And by that, I mean if you're investing in a 401k through your job or through an IRA, which stands for Individual Retirement Account. Think of these as buckets. You either have a 401k bucket or an IRA bucket or both, and in those buckets you can put money in. And that money can be used to buy stocks that you have in those buckets. As I've mentioned in a previous video, a 401k is a great tool for high-income earners to cut their tax bill. This is because whatever money you put in your 401k, you can reduce from your gross income, so the government will tax you only on that reduced income. Of course, once you take money out of your 401k during retirement, you will get taxed on that money then, along with the money that has grown. But you should be in a lower tax bracket by then, so it's all good. If you don't currently invest in your 401k plan, whether it's because your employer doesn't offer it or you're not full-time, what you could do is invest in an IRA. A traditional IRA works the same as a 401k. You put money in, it does not get taxed. Money grows, and when you withdraw, you get taxed. But a Roth IRA, ooh, that one is magic. That one works differently. You put money in, but you don't get the tax benefit. So basically your money from your paycheck or your wallet, which is money that has already been taxed, goes to your Roth IRA. Now that money in the Roth grows over the next few decades until you retire. But once you retire, all that money is tax-free, even the growth, guys. So for example, you put 10K in your Roth, which means that 10K you've already paid taxes on, and then let's say in 40 years that has grown to 100K in your Roth. Now that $100,000 is tax-free. God bless America. The thing to remember though, with any IRA, including a Roth, is that you can only contribute up to like 6K a year as of now. So if you didn't contribute 6K in 2019, you can't go back and add it. You can only contribute in the Roth for the current year onward. This is why it's so important to invest as soon as possible so you can put more money in and let the interest compound over time. I actually opened my Roth IRA during my residency, which I do recommend. It's actually the best time to open one because your income as a resident is very low, which means you'd rather get taxed now that you're in a low tax bracket versus when you're actually making money after residency. While a 401k is best for high income earners, a Roth is best for lower income earners. But the Roth is again great because the growth does not get taxed. So even when you're making stacks of cash, you should still have a Roth IRA in addition to a 401k. Oh, also, if you make over a certain income, you technically don't qualify for a Roth IRA, but that doesn't matter because you can just do what's called a backdoor Roth. A quick YouTube search will explain how to do it. It's actually super easy. Brokerage accounts. Last point, if you want to invest but not for retirement, you can open what's called a brokerage account. That's basically an account or another bucket where you can invest in stocks, but it's not a retirement account. That means that any money that grows, you can take out at any time, age 30, age 40, whatever, with no penalty. However, you do get taxed on any profit you make after you sell those stocks, so that's why they're more suited for short-term goals. So if you want to buy some index stocks with the goal of letting the money grow and then use that money to buy a new car or a new house in 5 years, then by all means, buy some S&P 500 in a brokerage account. A lot of doctors will actually get their paycheck, pay their expenses, including however much they want to pay it for their loans, and they'll dump the rest in a brokerage account because they want their money to grow, but they don't want to wait till they're like 65 to use it. The caveat is if you're going to invest in a brokerage account, make sure you're comfortable with the possibility of not being able to use that money for the next 2 to 3 years or so, because if the economy crashes tomorrow, you could afford to wait a bit for the economy to recover and then sell your stocks and buy that car. In conclusion, a good way to start investing is to invest in a 401k through your work and or invest in a Roth IRA. In the 401k or the Roth, just buy some index stocks. VOO is my favorite because it's in the S&P 500. Even if it is 100% of your portfolio, that's fine because the S&P 500 has a big stable companies that also do business around the world, and so they're very diversified. And once you're more financially literate, you can look at other index funds or bonds, and when you're pro, you can even start looking at individual stocks, but I would tread lightly on those. The only time I've ever lost money is with individual stocks. Thanks for watching, guys. The video only scratched the surface on investing, and I know I oversimplified a few things to make this video easier to understand, especially for newcomers. But if you need more information, feel free to go on the ODs on Finance website. They have some great resources. A lot of my financial literacy came from their book. I'll put the link to their website and the book below in the description. I hope this video inspired you to start investing and do more research on safe and effective ways to invest. And if you liked the video, please hit the like button below and consider subscribing. You don't have to, but you can. All right, have a good one, guys.